So, welcome everyone and good afternoon. Thank you for being with us today. Thank you for spending your lunch break with our luxury pricing webinar. I hope your sandwiches are ready, maybe next to your keyboard. So, luxury is a fascinating field because it does not follow necessarily the same logic as many other markets. Pricing, in particular, is not only a financial decision, but also a strategic signal. It shapes the perceptions of exclusivity, desirability, and value, of course. So I'm very happy we get to explore the underlying mechanics with Dr. Frank Müller today. Welcome, Frank. Thank you for being with us or with me today. Frank is the founder and CEO of the Bridge to Luxury. That's a luxury consultancy. He brings extensive leadership experience in the luxury and watchmaking industry. And he's also affiliated with our Institute of Marketing and Customer Insight at the University of St. Gallen, where he leads our luxury summer school executive program. A few words about that later as well. My name is Friederike Rierda, and I'm responsible for our executive education programs at our research institute. So after Frank's presentation, we'll also have time for your questions. We'll be very happy to read them in the Q&A or in the chat. So with that, I'm delighted to hand over to you, Frank. Thank you again, and I'm wishing everyone here an inspiring lunch break.
Wonderful. I hope you can hear me all. Can you hear me? Okay. Well, hello to everyone. I do welcome you to today's webinar on luxury pricing and luxury pricing management. Thank you for attending the session on an important topic that needs utmost care if luxury brands want to succeed. But before we start, please let me briefly draw your attention to the luxury summer school that will be hosted by the University of St. Gallen between August 11th and 14th. The luxury summer school is a 4-day program for professionals of the high-end industry. It provides an overview about modern luxury management strategies and concepts. It introduces into recent research, presents best practice cases, and offers dialogue and networking opportunities. In case that you are interested or you know somebody who could be interested, please reach out to Mrs. Reader or to myself. But let's start with our webinar on luxury pricing. What is today's content? First, let me share with you a little introduction, which will be followed by a chapter called Definition of Luxury, Luxury Pricing Goals and Specifics, Luxury Pricing Management. If we still have time, a case study of Mercedes-Benz and Ferrari related, of course, to luxury pricing. And finally, which I will not explain in detail, but in the document to be provided to you, you will also find a long list of literature with regard to luxury pricing. And for those who want to learn more about myself, in that document, some information about my background. So, consumption of luxury products and services is a unique phenomenon, and pricing plays a special role in establishing a universe of offerings that are highly sought after and considered exclusive and valuable. Luxury pricing follows management rules that are different from fast-moving consumer goods, for example. As an introduction, this webinar explains the characteristics of luxury and describes its pricing particularities, determining factors, and calculation methods. In doing so, it addresses two long discussed questions in research and practice alike. Does the so-called Veblen effect exist? And is luxury pricing a constitutive or merely descriptive element of the marketing mix when it comes to defining luxury brands. The webinar will also illustrate aspects of luxury pricing management, of course. Although pricing is a key element of successful luxury brand management, research on the topic is lacking. And with regards to terms such as high price or expensiveness, confusing. Indeed, it is confusing. Consequently, associating brands and their offerings to words such as prestige or premium or luxury, sometimes complemented by prefixes like hyper, ultra, or even, which I think stupidly, affordable, presents a conceptual challenge to both academia and the business practice. Thus, to be able to explain luxury pricing management, definitions are needed first. The following holistic model envisions to provide a practical theory for the scientific and management world. It is built on two pillars. A, the notion of auras, and B, the high-end brand matrix, a management tool that was developed by the consultancy firm The Bridge to Luxury. Let me please explain the importance of auras in luxury first. Aura. Light or color that can be surrounding something according to the Cambridge Dictionary. Interestingly, light in Latin is lux. So what we see here is a semantical overlapping of the words luxury and aura. The high-end model, aura is at its center. We know auras of offering, products, like the Birkin bag or 911 Porsche. There are auras of brands. There are auras of category. Champagne is a symbol of luxury, private jets, yachts. We also have aura of high-end, the life of the rich and famous, the upper class, those who have more than others. And finally, there's also a society aura, which sometimes is positive, luxury industry creating jobs, sometimes is negative, if we think about the perception of blood diamonds, for instance. So aura is important to define the universe that we are about to discover. So, to sum this up, or to implement auras and the high-end brand matrix, please let me explain. We have a social or society aura, we have high-end aura, we have categories, we have an aura about brands, again, Ferrari, Rolex, and we have the aura of offering. Before I explain in particular what is a luxury brand, let me simply complete this little journey. Some of these auras brands can control, obviously what they are offering to the market, and secondly what they're doing to create a brand. Some are beyond the control of the brands. The aura of a category, the aura of high-end, the aura of society. To define luxury, we need, per definitions, brand control, aura offering, and brand offering. The others are just sufficient conditions or external conditions. I don't want to go too much into detail about this, and rather would prefer to focus now on what is a luxury brand, because that we need to know if we want to speak about pricing, luxury pricing and luxury pricing management. Luxury in particular is a specific high-end offering from companies for consumers and defined by basically three characteristics. Firstly, as a necessary conditions, luxury consists of brands, products or services with unique, and that is important, measurable world record attributes that satisfy intrinsic as well as sometimes extrinsic consumer needs. So if we see here Ferrari world record, no automotive manufacturer has gained so many Formula One championships. Omega's Speedmaster so far was the first and only watch on the moon. Chanel, the first modern female dress. Meissen, the oldest European porcelain. Sunseeker in terms of speed of a yacht. Torini, the world's oldest continuously operating jeweler. So all these are explained by world records, measurable world records. They are being aspired beyond, luxury brands are being aspired beyond utility, investment, value. They also provide opportunities for identity evolution, experiences, social positioning, and interaction. That is very important if we define a luxury brand. So again, we have product world records, service world records, measurable, and on the other side, we have identities that tells the customer, you are rich, you are beautiful, you are still young, you are powerful, you are intellectual, attributes that describe a personality. So if we look at the Patek campaign, you actually never own a Patek Philippe, you just hand it over to the next generation. Or if you look at this dream world of Steinway, it's a princess just following her love for music, detached from any daily realities. Those are typical identities that we can attribute to luxury brand. Secondly, as a sufficient condition, luxury is also founded on general product category and high-end auras. Again, champagne, yachts, private jets. And thirdly, luxury can be subject of controversial social, moral and political discourse, given its limited accessibility to wealthy individuals, its high consumption of resources and production, and its association with unlawful abuse, all of which may create a polarizing aura. Having tried to define luxury, let us move on to our specific topic of pricing. If we ask ourselves what are the general tasks of pricing, we can have a look on company level and consumer level. Let's start with companies. Pricing serves to secure revenue, profit, cash flows, growth or market share, and therefore is reducing entrepreneurial risk. It also means being different from competitors. Those are the two principal tasks of pricing. If we now look what consumers think about pricing, for them it means expressing a certain perceived value. Consumers acquire goods and services if they are perceiving value in them. Prices provide an indication of such value and enable comparison with market alternatives. Customers choose the offer that provides the greatest personal value by weighing potential gains, obviously against cost. These costs can be monetary, procurement time, distribution effort, or psychological expense, while gains consist of product, service, distribution, or personal values. For customers, pricing is therefore critical in assessing an overall offering's value to create satisfaction. Now, having defined these more general tasks, let's have a closer look at the luxury pricing specifics. There are overall 5. which I will explain in more detail in the upcoming minutes. There are high prices, small production numbers and high cost, price reductions and global price harmonization, luxury consumer needs and price elasticities, which are different from mass volume markets, meaning functional needs, economic needs, identitarian needs, and finally experiential needs. And fifth and finally, we have multiple stakeholders. These 5 elements set luxury pricing and luxury pricing management apart from other sectors or product categories or industries. Hang on, that was too quick. Let me start with number 1, high prices. Prices for luxury offerings are higher in comparison to similar offerings. Brands justify those higher prices due to their offerings' unique functions and utility, elaborated production processes, for example, the degree of craftsmanship, special materials, gold, diamonds, for instance, innovation, quality, and reliability, as well as additional non-functional benefits. Small production numbers and high cost. Production numbers for luxury offerings are small, while manufacturing costs per unit are high because of labor-intensive craftsmanship, prestigious materials, and so on. However, brands not only have to cope with often high production costs, but moreover with those for communication, activities amounting sometimes for more than 25% of revenues, just to give you an example. Particularly, substantial investments into the customer luxury experiences are a challenge too. Brand boutiques, events, collector clubs, shows, giveaways. Being allocated to few cost bearers only, brands need an accurate assessment of customers' potential lifetime sales cycles, revenues and costs to define appropriate prices and to ensure long-term profitability. Thirdly, price reductions and global price harmonization. High luxury prices with often high wholesale margins create the risk that along the value chain distribution partners offer and smart shoppers seek price reductions. Especially in times of economic downturns, grey markets can be flooded with discounted goods. In the digital age, luxury prices are globally transparent. In consequence, parallel markets with international flows of merchandising developed that are not brand controlled and in line with distribution strategies anymore. Therefore, price reductions can damage a brand's luxury myth and disappoint consumers who have believed in sustainable values. Yet, discounts are not only bad for image, they also hurt brands' bottom line. Just to give you an example, to compensate for a profit loss, given a product gross margin of 40% and a discount of 7%, a brand would need to increase sales by 14%. Just to achieve the same profit after a discount of 7%, the brand needs to increase revenues by 14% for the same results. So discounts are a very big issue of luxury pricing and do need a lot of attention of the luxury brands. Ideally, a brand's offering is globally priced at the same level on a net basis to avoid spreads between different markets and to discourage parallel markets. Yet internationally, various and dynamic parameters such as taxes and duties, currency exchange rates, commodity prices, gold, diamonds, local wholesale margin systems, and so on define a complex frame to achieving the goal of constant global price harmonization. This task is even more challenging as prices in luxury cannot be easily lowered to protect perceived brand value and profitability, thus limiting options in pricing decision-making in comparison to fast-moving consumer goods. Prices for luxury offerings are higher in comparison to similar offerings. So once again, one of the very important issues in luxury pricing and luxury pricing management is that ideally prices must not go down. Brands justify those higher prices due to their offering's unique functionality and utility. Elaborated production processes, special materials, again, innovation, quality, reliability, as well as additional non-functional benefits. Now let me please come to the fourth point, luxury consumer needs and price elasticities. Luxury goods and services provide, as I have said, non-functional benefits beyond offering's basic utility. Consumers believe that the perceived value can be more important than its elementary utility. The consumer's evaluation of such values is based on 6 fundamental needs, of which 4 are intrinsic and 2 are also of extrinsic nature: functional, economic, experiential, identitarian. While luxury shares the consumer's need for functionality with industrial or fast-moving consumer goods, the other 3 are quite specific. All 4 needs contribute to a consumer's perceived value of an offering and therefore are very relevant for pricing decisions. Let me start with functional needs. A luxury product or service is supposed to solve a consumer's problem. Telling time, watches, transporting human beings, yachts, cars, planes, and keeping them warm, clothes, shoes. Carrying measurable world records in comparison to offerings from premium or prestige brands, they do so in a superior, innovative, and thus unique way, justifying pricing markups. Economic needs. Consumers purchase luxury goods based on complex monetary considerations. They expect extraordinary product quality to ensure in particularly long service life and thus lower depreciation over time, resulting in a later date for a repeat purchase. Furthermore, the acquisition of luxury goods can be speculative in nature. One aspect is the so-called hot hand fallacy phenomenon. Customers buy today because they assume that the price of the product will rise in the future. As in luxury, already expensive offerings tend to get more expensive, consumers wish to anticipate potential savings in bringing forward a purchase. A second speculative motive is founded on potentially high resale values of a formerly acquired Ferrari, Rolex Daytona or Birkin bag. Their second-hand market price may even be much higher than current official ones, therefore promising profits and attractive returns on investments. Let me now please move on to identitarian needs. Luxury offerings are purchased not only for functional or economic reasons. They also provide identity which can be of intrinsic and extrinsic nature. They are an expression of self-realization and empowerment. Consumers acquire luxury products to reassure themselves to be knowledgeable, beautiful, rich, cultivated, powerful. Also, as an extrinsic need, luxury products can provide identity vis-à-vis a consumer's personal environment to provide social orientation, interaction, and positioning. In 1899, long time ago, Thorstein Veblen formulated the theory of conspicuous consumption, indicating that consumers buy luxury goods to achieve higher social status. Harvey Liebenstein, some 50 years later, built on Veblen's work on social signaling in analyzing 2 seemingly opposite effects. The first effect is the so-called bandwagon effect. Through their purchases, consumers indicate their belonging to a particular social cohort. The second effect describes the opposite phenomenon. The acquisition of luxury goods and services signifies that its buyer represents elite independence, the so-called snob effect. In both cases, however, consumers aspire luxury products that position them as socially superior. As luxury products and services therefore offer more than just utility and economic value, buyers are ready to pay a markup. Today, research on conspicuous consumption is elaborated, and it is also explained by theories such as congruence theory, value belief norm, or the self-concept theory. Part of Leibenstein's theory is the Veblen effect, which was not invented by Veblen himself, but just named after him. It focuses on price elasticities and assumes that the higher the price for a luxury offering, the greater the conspicuous signaling value is, which results in higher demand. The Veblen effect thus depicts a positive elasticity of demand. Although the concept describes an aspect of conspicuous signaling too, it is different than the idea of bandwagon or snob, as it formulates the consumer's goal of social ranking and not belonging. Consumption becomes a signal of personal financial means and purchasing power. The assumed Veblen effect is fascinating as it contradicts the generally expected negative correlation between price and demand, but intuitively fits the notion of luxury being an unusual expression of consumption. It has been the topic of intense discussions in academia and business practice over the last 60 years. Despite its popularity, however, the effect's existence has not been yet proven convincingly. The reasons are threefold. Firstly, the effect does not suggest that the price itself triggers higher demand, but is merely an indicator of a concrete incremental value proposition, which is social signaling. Consumers do not want to pay high prices just to be overcharged high prices. The Veblen effect does not suggest that the price itself triggers high-end demand, but is merely an indicator, as I have said, for social signaling. Price in marketing is only captured, but not a creator. And we have to admit, in reality, there are no infinite prices. Any demand curve eventually flattens out, because in theory, brands would raise prices ad infinitum and therefore would expect demand ad infinitum, and obviously that does not exist. And finally, how to measure a Veblen effect in real life. It is difficult on a methodological level to measure a Veblen effect. The impact can hardly be extracted. Value perception of a luxury offering does not depend on price and identity alone. Other consumer benefits such as product, utility, economic value, brand experience are relevant too. So are influencing competitors' activities, new products, price changes, in shaping consumer product and service assessments. Neither in the limited world of laboratory experience nor in real business practice it is possible to single out under what we call ceteris paribus conditions the singular impact of a price increase on the consumer perceived identitarian gain. Indeed, the full range of spill and carryover effects of all marketing mix and competitors' activities, as well as other impacting factors, cannot be isolated to prove the effect, that the effect exists, and if it does, to find out to what degree. However, market research methods such as conjoint analysis can nevertheless help brands to find out approximately if and to what extent consumers are willing to pay more for an offering in gaining perceived value of intrinsic or extrinsic identity. Indeed, there are consumers who prefer not to reveal their high income and wealth through ostentatious signal consumption at all. The fourth and final consumer need after utility, economy, identity is the experiential needs, or are the experiential needs. Brands events, enriching exchanges in collector clubs, or the enjoyment of using a product that is special create a particular aura of luxury that consumers strive for, offering fun, entertainment, dialogue. Providing luxury experience for customers is an important investment for a brand. Consumers may even be willing to pay more to attend an event than they would for the product itself. There are plenty of examples. If we, for instance, look at the experience program of some watch brands, it is quite amazing how much money people are willing to pay for being the one who opens the Vatican doors in the morning, undisturbed by any other tourist. And that example concerns the Italian brand Panerai. So let me come to the fifth and last specific luxury pricing characteristic before we move on to luxury pricing management. The luxury consumption market is not limited to the traditional supply chain involving suppliers, brands, distribution partners, and customers. This is, as I have said, the fifth luxury pricing specific feature. Given the socially polarizing nature of luxury, which is often considered to be a form of consumption that absorbs a lot of natural resources and is only accessible to elites, it is also monitored by additional stakeholders such as governments, NGOs, the media. Luxury attracts attention not only from consumers but also from the general public. It can elicit negative reactions and emotions. And that is very important to observe, because it has implications for pricing, as brands need to foresee and absorb investments along the supply chain, especially at supplier level, in order to protect the brand image. This includes ensuring healthy working conditions for textile employees, fair salaries, schools for children of parents who work in mines, and of course environmental protection at production sites. All this needs to be assessed and priced in to the price of a luxury offering. So to sum up, the unique and multifaceted framework of luxury pricing management is characterized by high prices, generally small production numbers, elevated cost, limited scope for reducing prices, complex luxury consumer needs, and multiple stakeholders. To succeed, a holistic approach is required that integrates exhaustive market research and analyzes pricing goals, strategies, and professional implementation. And this approach consists of 4 stages, which I would like to explain now. The first stage is, of course, analyzing your brand, the consumers, competitors, the Michael Porter approach, driving forces, driving industry forces, threats of substitution, suppliers, environment. The second one consists of defining goals, financial ones, revenues, cash flows, profitability, market share, growth rates, target groups, differentiation, recognition, image. And again, these goals are not only short-term, but may be defined along the whole life cycle relationship with one customer. Thirdly, strategies. There are basic strategies, cost plus, value-based, competitive pricing, differentiation through pricing. And then there are additional strategies, which I will explain in a minute. And fourthly, implementation with regard to the marketing mix, with regard to infrastructures needed and financial capabilities. All this needs to be done in a dynamic, revolving way, so that constantly we analyze our position, pricing position, our goals, our strategies, how we implement, and to come back to start the cycle. Now, what are the 4 basic luxury pricing strategies? Given the short time frame, I will just briefly explain each of the strategy without going into the advantages of disadvantages, which you can read about once you have downloaded or received the documentation of today's webinar. A very common one for luxury pricing is the cost-plus pricing. The selling price of a product is determined by adding a specific fixed percentage or multiple to the product's unit cost. To give you an example, in the watch industry, the factor ranges between 4 to 10. Pricing is primarily based on data from cost accounting. The second strategy is value-based pricing, price setting according to estimated or perceived value and customers' willingness to pay for it. Pricing is primarily based on information about the value created for the customer. It is an alignment of prices and values. The third one, competitive pricing. Pricing is primarily based on information about competing offers and prices. And a little bit related to this third strategy, price differentiation, different prices for different customer segments. Here the idea is if you have clearly separated target groups or market, you can price for the same product differently according to the specific local circumstances or consumer needs or willingness to pay. Then there are additional luxury pricing strategies, exclusivity pricing, creating exclusivity and thus higher willingness to pay, product limitations, waiting lists, or expected customer sales history. Here this would mean that you only get a product if you have qualified through former purchases, which is quite common in the car industry and the watch industry in particular. And then you have decoy pricing, offering a very expensive product to make other products option C more reasonable. So you have sort of a master line, master series, or you have limitations, and those shine down to the rest of the of your offering. A typical case are the fashion shows in Paris, where we would see very expensive, fantastic fashion, which in generally is not sold to the general public. So if we take the example of Chanel, it would be we would attend a flashy, superb fashion show, and many people, millions of people, will end up buying Chanel number 5 on the ground floor of a department store. So that's the idea of decoy pricing. Bundling, combining products or services into a package. You can get this one if you also buy that one. Generally directed at distribution partners who need to buy slow movers to get top-selling offerings. And finally, quite known, I believe, sales of goods at auction houses or internet platforms. What are the dynamic factors in luxury pricing management? Analyzes. Pricing is an element of various management disciplines that all need to be considered as intercorrelated. R&D, production, communications, distribution, infrastructures. The goal is constantly global harmonized retail prices on a net basis. To achieve this aim, luxury brands need to continuously monitor consumer perceived values, competitor activities, taxes and duties, very important currency exchange rates, commodity prices of gold, diamonds, and so on. Also, locally different pricing systems need to be put into consideration. I just recently learned from a friend of mine, Andreas Mann, who is an expert on Japan, the example of kakeritsu. It's quite interesting because the export price from Europe is calculated ex post according to discounts granted to final consumers or customers by retail partners. So the department store in Tokyo has sold jewelry with a discount of 10%, and therefore the department store would be entitled to a kickback of 10% on landing cost, which obviously creates an awkward situation for the brand, not knowing what final revenues will be sending products to Japan. There's another example, Hong Kong. We need to consider year-end financial kickbacks to retailers for example, the number of product facings in the shop window. There may be an extra commission for golden watches sold. So it's seldom just straightforward. You ship the goods at a certain price and good is. No, quite often you need to consider discounts or kickbacks at the end of the year. Now let me get into the marketing mix of luxury pricing management. The idea is, as I have said, keeping prices at least stable. Constant product and service innovation at luxury world record levels. That is one of the top means to keep prices up or to help the brand to raise prices. Offering master lines, limited editions and bespoke offerings. Artificial limited production, and king of town is certainly Rolex with his artificial limitation of the toners. And if somewhere we have to lower prices, we can do so in introducing cheaper novelties. Marketing mix and pricing itself, we have already touched a few aspects. I believe abstaining from price increases over time. So we can reduce prices if we don't raise them. We keep them at the same level, and through inflation, products will get cheaper without the customer being lured into sales and discount offerings. Particular in luxury is that we are up-rounding prices instead of the famous 999.99 offerings, because we don't want to make products cheap. Instead of discounts, we can compensate through goodies, invitation to events, gifts. What is very important is to be aware of tax-related transfer pricing challenges, because they can screw up your calculation in a painful way. Communications increase the customer luxury experiences, boutiques, one-to-one communications, and so on. Defining customer waiting list is a painful mean for customers to understand, okay, this is elite, you have to buy your way up to get the true hot stuff. Distribution, obviously thoroughly prepared selection of wholesale partners, retailing owned boutiques and e-shops instead of wholesale partners to control prices and the flow of merchandise. Dynamic factors in luxury pricing management, infrastructures and organization. Scenario planning and realistic sales forecast and budgets to avoid overproduction. And to my experience as a former brand CEO, member of the management board and a long-time consultant, this is one of the weakest aspects I witness the brands I have dealt with. Scenario planning and realistic sales forecast. If we're not realistic about it, eventually we will run an overproduction, and with too many goods laying on the shelves, we need to get rid of them, and the answer is discounts, grey market, over distribution. So overproduction leads to over distribution, which we don't want, obviously. We need price precise cost accounting systems, a culture of pricing discipline. We need sales representatives that defend the brand and product value proposition instead of pushing deals. And this is a complicated one. We need sales remuneration based on saving gross margins, contribution instead of sales volume. That's not an easy one, but would help brands to avoid a loss of margins and profits. Incorporating international tax experts, flexible production processes, sufficient funding, example for marketing, buyback programs, physical destruction of overstock. Just very briefly, a short case before I conclude. Mercedes-Benz announces a new luxury strategy in February 22. It mentions Ferrari as a benchmark. Now let's have a look at Mercedes-Benz. We have the A-Class, B-Class, C-Class, up to the Maybach. There's a huge price difference, and we ask ourselves, if that were a luxury brand, where are the world records, except perhaps that Mercedes-Benz was invented, or the first car was invented by Mercedes-Benz. If we look at the offering, we have 8 classes, 6 executions, 3 different motors, so we have 144 basic options, plus various motor powers and the additional configurations. Now, if we look at communication, ask ourselves, okay, besides world record, what about identity to define a luxury brand? This is an example of an advertising in India, Mercedes-Benz India. What do we see? We see discounts, we see price reductions. And if we ask what is the personality, the identity of our potential customer, it's about win the day, whatever that means. So, in summary, if we look at the market capitalization since this February 2022, when Mercedes-Benz announced its new luxury strategy, well, today Ferrari has basically the same market capitalization as Mercedes-Benz. Although Mercedes-Benz has assets of 255 billion euros, revenues of 96 billion, delivers 1.8 million cars a year. It just has an EBIT margin of 4.9%. And if we compare that with much, much smaller Ferrari, well, the basic difference is EBIT, where at Ferrari we're almost seeing 30%. So luxury pricing is a complicated, demanding exercise in luxury management. It cannot be viewed as an isolated tool. The products need to be right, communication needs to be right, the culture of the company needs to be right, many, many factors to look at. And with these remarks, I want to conclude and thank you for your attention. Again, this was just an introduction into luxury pricing management. Nevertheless, I hope it was a valuable exercise for you, a valuable experience. And once again, thank you very much for your attention.
Thank you so much, Frank, for this very comprehensive overview. I take home pricing is not an easy and extremely multifaceted task. Ladies and gentlemen, we have time for your questions. You can type them in the chat, or as we're an exclusive group here, you can also just unmute yourselves. So maybe I start. I think we can agree it may not be Mercedes, but do you have any examples of pricing leaders within the luxury industry, Frank?
What's that? Sorry, I didn't get your.
Are there any companies that you regard as leading in terms of pricing?
Well, Hermes certainly is quite disciplined because they have started early to venture into retailing. So through their boutiques and their online shop, e-commerce, they control the flow of prices. They have access to the customer databases, and therefore their life of controlling pricing is much easier. Then we have the example of, again, Ferrari, and now I would compare it with Porsche. I recall well many years ago when I read in an article that Porsche would envision 200 to 300,000 units a year. If we compare those numbers in those days, I think some 30,000 or 40,000 units, with Ferrari's units or production deliveries in those days and today, Ferrari is at 15,000 and Porsche is at these 200, 300,000. And that obviously creates issues if we are speaking luxury in the sense as we have defined it, world records. So the issue is if you're producing 300,000 units a year, what type of world records do you need to justify to be considered a luxury product? And already it's an aspect of volume, I think. Mm-hmm.
Thank you, Frank. Tobias Steiner, you have turned on your camera. I assume you're having a question.
Yes, thank you.
Please.
Would you mind to elaborate a little bit on the Mercedes-Benz example, because I quite not get the point. What was the strategy shift and how did it affect the brand?
Fantastic question. Thank you very much. Now our topic today is luxury, and we have defined luxury. Or maybe let me go back to my presentation for a second, because I hope you can see that. So the initial question was, what is luxury? And we have defined it as offering a world record and providing identity. So I don't believe that Mercedes-Benz, with all modesty required, I'm just a small consultant, that there's a semantical misunderstanding about what is luxury. So if Mercedes-Benz wants to be luxury in the pure sense, qua definition, they need to provide world records and identities. And here I have my doubts. So today, looking at what Mercedes-Benz is offering, I'm not sure what type of brand that is. It may be a prestige brand, it may be a premium brand, it may be a prosuming brand, but it's certainly not a crystal clear luxury brand because it's not offering enough world records. The offering is too wide, and identity-wise, well, what is it? Is it a family brand? Is it a Formula One brand? Is it a brand for trucks? So all that is existing and relatively successful. But if our strategic ambition is to be a luxury brand, I think Mercedes-Benz has no chance to get there.
Thank you, Frank. Here in the chat, we have two more questions. One regarding exclusivity from Tobias Auchli. Can brands go too far with waitlists and frustrate clients?
Can customers get too far with
waitlists and limit demand and ultimately frustrate clients?
Yes, and it shows in several categories. Sometimes there are too many of them, and the limitation becomes how should I say, is overfloating the market, and everyone understands it's just a cheap marketing trick, another dial on a watch, yet it's the same watch, just changing the color of a dial. So it can be too much if we overpace that idea of limitations. And of course, as a customer, it can be quite frustrating if you're a young buyer and you need to work your way up. If I have the means, the financial means of a certain car or a certain watch or whatever it is, a certain play, and I need to buy the cheaper stuff beforehand before I can qualify for the real goodies, obviously that is frustrating. But don't forget, yes, luxury is about a painful experience for customers, because if it weren't, then we don't have this identitarian aspect which we have discussed. The snob effect that is for conspicuous consumption very important. I want to make a difference through my consumption, and therefore it's got to be painful for those who cannot afford or can only afford at later stages.
Thank you.
And by the way, I believe in today's democratic world, luxury brands too seldom do not dare to be painful to the audiences, to say, well, sorry, you're a nice person, but certainly right now you do not qualify for our products. That is a message in nowadays that is rather seldom, yet I believe it's part of the potential communication strategy of a luxury brand.
Excellent. Another question. In your opinion, Frank, why do high-end watches like the Rolex Daytona list at odd figures like 70,100 Swiss francs instead of clean round numbers like 76,000 Swiss francs? Many brands do that.
That's correct. One likely explanation is that the watches are shipped to the retailers, wholesalers in various countries on a net basis, and they then would simply add the either 17, 19, 22% of local consumption taxes. Or if we take California, I think it's 8%, and New York is 7 or 3 or whatever the number is. And therefore the net price is the same, and the difference is then the added taxes.
Great. So that's actually some pricing transparency there. Right now there are no further questions. Any more? Feel free to unmute yourselves. Otherwise, we're almost towards the end. Thank you so much for being with us. If you would like to explore those topics further, really discuss in depth, feel free to join us this summer in St. Gallen. We'd be very happy to host you here and bring you together with other participants from varying industries with a wide selection of practice experts and from academia. And also, of course, feel free to reach out through LinkedIn or email anytime.
Thank you very much.
Frank, do you have any concluding remarks?
No, not really. If you have further questions, again, feel free to reach out to Friederike or to myself. And we are happy to engage also on a personal level if there are some remaining questions or requests for additional information. So don't hesitate to contact us. Again, thank you very much for taking your time today, and we wish you a wonderful afternoon.
Exactly. Thank you so much. And I'll send you the link to the recording and to the slides next week. So have a great afternoon, everyone. Bye-bye.
Bye-bye.
Thank you.